Warm welcome to the first ever, I must say, webinar by Carbon Equity on the fundamentals, the basics of private market investing. And I'm excited to have you here. It's a bit of a mix, I see, of people who are rather experienced with private market investing and have less experience. I'd actually be very interested to get a little bit of a feel for the audience. So I'll launch a brief poll on your investment experience before we kick it off. So how much experience do you have with private market investing? None at all. Have you invested directly through angel investments in the past? Have you invested in a private market fund, fund of funds, or all of the above? Cool, I see that answers coming in. I give you 10 more seconds to get your answers in here. All right. Okay, 5, 4, 3, 2, 1, ending the poll here. All right, okay. So indeed, it is a bit of a mixed bag. We have quite some few people who have no experience whatsoever. We have a couple of angel investors or direct investors. I have a few who have invested in a fund, a few the same perhaps who have invested in a fund of funds, and some have invested in all of the above. So today what we're going to cover, sorry, did I share the results? Yeah. Did you get that on the screen? Okay, perfect. All right. Cool. So we're going to cover a couple of basic topics on private equity. And to set the expectation, the level of this seminar is really meant for people who have limited to no experience in investing. We will have follow-up seminars which cover more advanced topics. We have Wiebe on call, who is an absolute fund of fund investing wizard. So you may feel free to ask any questions to him as we go along, or after the webinar, of course, there's ample time and space to ask any questions you have on more in-depth topics.
Good morning, everyone.
I'll introduce in a bit, Wiebe. So we're going to cover 4 topics today. What is private equity? Why should you invest in private equity from both an impact lens as from a returns financial investment lens? Third, how can you invest in private equity? And fourth, how do funds work? So we're going to cover a lot of ground. It's a lot of topics. We're going to try to compress it and sort of like cut it to the bare minimum, because I really want to keep some questions for Q&A, and otherwise we might run a little bit over time. But again, feel free to ask these questions offline. So a few huishoudelijke mededelingen or sort of upfront announcements. Again, this is covers the basics, not so much the advanced in-depth technical topics. And secondly, this is not a seminar per se on impact investing. We will have a separate seminar on climate impact investing. How do you move the money? How do you move the needle on climate change with money? Today, we have a more financial focus, just to set the stage. Secondly, again, I see a lot more people joined in the interim. Kindly, if you want, write your name and your role in the chats, just to get to know each other and get a feel for who is here. And in terms of Zoom, kindly ask any questions you have in the Q&A. After the webinar, we will have a short moment to do Q&A. Then you can raise your hand. I already saw one person who raised their hand, and then we will invite you to the stage to share your question and have a discussion with myself, Wiebe, and Lara on the call. All right. So who is here? So I myself am the co-founder and CEO of Carbon Equity. I have a background both in investing and in entrepreneurship. So I worked several years. I started my career with Hall Investments, a large private equity fund, 12.5 billion, well known in the Netherlands at least. More recently, I was a partner at Peak Capital, which is a venture capital investor. And I spent several years building companies both in the Netherlands and in the Philippines, Southeast Asia, as an entrepreneur. I have here on the call as well Wiebe Visser, as I said, our fund of funds investing wizard. Wiebe is our investment advisor, and he spent over 11 years with Alp Invest as a principal, investing in primarily in secondaries. And He is an absolute expert when it comes to fund investing. So make use of the time that we have with him and feel free to ask any questions. And Lara Kolen, she is our Chief Investment Officer and co-founder of Carbon Equity. Lara pretty much set up Philips Ventures, which is a large healthcare investor, a portfolio of approximately 1 billion investing directly in companies and in fund of funds. So that's the team for you today, ready to ask and answer any questions. Cool. Just a very brief note on carbon equity before we start, because not all of you will be familiar with carbon equity. Carbon equity is on a mission to decarbonize the planet. And one of our theses or underlying beliefs is that we need investments to build equally good technologies. Once you have an Oatly or say a Beyond Meat burger, what you see is that people massively shift to the greener alternative because it's better, it's cleaner, and perhaps at times or in the future, hopefully even cheaper. So our mission is to build equally good technological alternatives to current behaviors to really move the needle on climate change. And for that, we need a lot of capital. According to JP Morgan, we need approximately 50 trillion invested in low carbon or zero carbon technology and infrastructure to transition towards a net zero future. And that is at the same time one of the biggest economic or investment opportunities of the century. It's inevitable. Regulation requires net zero towards the future. There is no other way around it. Consumers are asking for it, companies are asking for it. So the trend towards net zero and the fact that when you build a valuable lower carbon solution, you open up an incredibly large market is very clear. And so increasingly people are starting to look at how can I get into the climate investing game, because it's no longer just about impact. It's also simply about a massive opportunity. And we believe that the biggest value creation opportunity, both from an impact point of view, as from a returns point of view, is in private markets, not in public markets. And we'll discuss that in more detail as we go along. However, the vast majority of people have no access to private market fund investments. And that is what we fix. And so carbon equity enables small ticket investments in the world's best climate funds. We'll tell you a little bit more about that as we go along. And so ultimately our mission is to help billions of people to invest or to help millions of people to invest billions in building a net zero economy. Billions of people is also okay. All right, so let's get started. What is private equity really? Now, starting at the very, very, very basics, look at your portfolio and what is in your holdings. What is part of your net worth? How have you allocated your net worth? Part of that might be in cash. I hope not too much, because cash costs a lot of money due to negative interest rates. Most people and most wealth holders will have a sizable allocation towards real estate. You might own your own home. You might invest in real estate, in second homes or lease out your homes. So most people will have some real estate allocation. Some people will have some fixed income allocations. You can also do that in renewable and also in the climate sphere. Duurzaminvesteren.nl is, for example, a great place where you can participate in fixed income loans or bonds. You basically issue a loan to a company and can earn returns between 2 to 7% on average, typically. Or you can invest in equities, and that's what most people will already be doing. Also, people who said, I have no experience in private markets, they might be investing in the public equity markets through stocks. And then, of course, you've got private equity. Private equity is notoriously inaccessible, has only typically been accessible to professional investors or ultra high net worth individuals who on average allocate a sizable proportion of their portfolio to private equity. And so typically that's why individual investors have limited exposure to this. What is private equity then? Private equity typically describes an asset class or a group of asset classes consisting of venture capital, which is early stage investing, growth capital, which is all about scale investing, leverage buyouts. We'll talk a little bit more about that. Leverage buyouts are where a fund will buy a majority share in a company from existing shareholders and take control of the company. And they will often finance that with debt financing, so bank financing. That's why the name leverage buyout. And private debt can also be part of the private equity asset class. And when you read about private equity deals, typically they can also refer to the leverage buyouts. When you say it's a private equity deals, typically you would think of growth equity or leverage buyouts. When in principle, private equity describes the full set of asset classes. If we think a little bit about the lifetime of the company, the journey, the funding journey or the financing journey of a company, we can picture it as this. You typically start with an original idea, with a PowerPoint plan and a team, and that's where you raise some initial funding from what we call friends, families, and fools, and perhaps angels, or fools and angels might be more or less the same. And so these are people typically close to your network who really gamble and they bet on you personally. Then once you scale up a little bit, you have some proof of product market fit. This is when you're ready to take on an institutional investor, like a venture capitalist, and that's where you raise some seed funding. As you grow bigger, have a little bit more traction, more proof, that's where you get a Series A investor. And as you go along, you raise further and further series. So we call these series A, Series B, or Series C. I'm not sure what the latest or the record letter in the alphabet is. I think I have seen some Series H or more. But in principle, venture capital describes everything from pre-seed up to late Series A, maybe Series B. And then that's where at some point you get into growth equity, where you have proof of company. This is where it's all about scale. Series B tickets will be in the range of 10, 20 million, up to several hundreds of millions. And then ultimately a company will hopefully want to exit. So they might go public through an IPO. They might be acquired in a strategic transaction. Or this is where private equity at some point comes in, a leveraged buyout fund that might buy a majority share of the company and then transform the company. All of those roles, venture capital, growth equity, and buyouts have a role to play when it comes to decarbonization. Venture capital is obviously extremely important from a driving innovation point of view, bringing new innovations to market. But a lot of the technology that we need to decarbonize the planet towards, especially towards 2030, already exists. So growth equity is extremely important in scaling what we have. And I think a great example of that is, say, Beyond Meat. This is alternative proteins. They've gone through this R&D, initial innovation phase. And then it's all about commercialization, continuous product development, but really getting it into the supermarkets, getting it into the shops and driving down the cost curve to get as much cost competitive as possible with regular meats, so that you make sure you get to cost parity, as a result of which you can really drive massive scale. And also buyouts can have a role to play in transitioning an economy by buying typically laggard companies that have a large carbon footprint and transitioning them through a majority ownership, and so a controlling stake in the company, transitioning them towards lower carbon business models. I'll focus here briefly on venture capital and growth equity as two highlighted asset classes within the private equity sphere. Those are the asset classes that within carbon equity we really focus on. So venture has three characteristics when you look at companies. They're early stage, they're typically super high growth, otherwise you would not, as a venture capital fund, want to invest in them. And they're typically focused on a new innovation. It can be a technological innovation, a product innovation, or it can be a business model innovation or other innovations. And as an investor, from an investment point of view, the key characteristics are that you take a minority stake. The earlier a company, the more as an investor you're betting on the founders. So you want the founder to have skin in the game. You want them to be working on this 24/7. And so you never want to take a majority stake, always a minority stake. So that the investor is really, the founder is really motivated and has a lot of, a high stake in the company. It's typically a high risk, quite a percentage of Early stage companies fail in these early stages. But it's also super high return potential. Imagine having invested in a Tesla before it went public, it would have made just a huge, massive return. So high risk, high return, those typically go together. Now, what is the value creation model of venture capitalists? How do they add value? The first is to provide capital. Typically, startups would be nowhere without external capital. They cannot fund their growth. So providing capital is important. Secondly, very important is network. So good venture capitalists will really bring in a lot of strong commercial network and also an investor network for follow-on funding to really help the startup build their network. And the third is through strategic advice and thinking along in every step of the process. So here are a few examples of a couple of venture deals that are either in the carbon equity portfolio or in our pipeline from a couple of funds, 2150 and the Energy Impact Partners Fund, to illustrate what is climate venture capital. Now, one of my favorite examples is Carbon Cure. This was part of the 2150 fund portfolio that we recently closed. And Carbon Cure is a company that developed a new technology which allows cement factories and coal companies to capture carbon, and then they inject that carbon into the cement itself, which actually makes the cement stronger. So it's both a cheap way of fortifying cement and a long-term storage solution for carbon. So incredibly cool innovation, and they're currently scaling that up. Another example from the Energy Impact Frontier Fund example is Boston Metal, awesome company. And it's the first company in the world that produces zero emissions steel. And for people who are not familiar, steel is responsible for 6-7% of total global emissions. So really a massive contributor to global emissions. And the ability to create zero carbon steel is therefore a super important innovation. Form Energy does grid scale battery storage. And the more renewable energy we have, sun and wind, the more intermittency we have, and the more important it is that we can store energy. Interesting fact from the Bill Gates book. I'm not sure who of you read that book, but if you take the example of Tokyo City, if Tokyo were fully powered by renewable energy, and if the city, if there were no sun or wind energy for a single day, the city of Tokyo would need all of the batteries in the world to power it through a single day of energy. So grid scale battery storage solutions are super crucial in sort of moving towards a net zero future. Growth equity, key characteristics of companies in a growth equity phase are, first of all, these are mature companies. And they typically don't have the same level of market risk or product risk that venture companies would have. They're in a scale phase, and typically they already have quite meaningful revenue. So think 20 million euros plus, 10 to 20 million euros plus in revenues. And the key investment characteristics are still that you take a minority stake, so still not a majority stake, but ticket sizes are much larger. And so investments will range from 10 up to, say, a few hundreds of millions. And it is less risky than venture capital investments because you no longer have that the product risk and that market risk. So how do growth equity investors create value? They provide capital. So still super important because this is where you have built the engine of the car and then you need to fuel the car. So it's all about investing capital to fuel the growth of the company. But these funds typically also help with professionalizing the organization. And that can be by adding key hires so it can be by placing key hires in the management team, or it can be by adding an operational partner to the team, either temporary or fixed, who then really helps professionalize and scale up the operations. A few examples from the portfolio and the pipeline again, a few examples from Wellington Management. That's a growth equity fund of 1 billion euros that is currently in our pipeline of funds. They recently invested, I think it's just last week, in a company called Arcadia. And Arcadia is a company that raised 100 million amongst others from Wellington. And what they do is they allow any retail customers to make use of solar community energy. So solar community energy are these projects where you will take, for example, a factory, you put lots of solar panels on the roof, and that generates energy. And Arcadia allows you to buy this energy without switching your utility provider. And so it makes it a lot easier, more accessible, and very sizable company, a lot of traction, super interesting. So again, a brief overview of the different private equity asset classes. When you get this presentation, and this provides a brief overview of the different asset classes. Before we move on to the next part on why to invest in private equity, Lar, have there been any questions that you would like to answer here on stage, or shall we continue?
Hi, thanks, Jacques. Let me make sound so I come into view for the first time. Good morning, everyone. There have actually been quite a few questions, mostly around content that we will be addressing later in this webinar. Cool. So I suggest we continue, but I do want to make note of the Q&A tool. So please remember to add the topics or questions that you have so we can address them during this conversation. Thank you.
Great. Okay, so before we launch the second part of the webinar, one question to you. So another poll. Now, understanding a little bit what private equity is, and prior to having heard why you should or should not invest in private equity, what percentage of your capital would you want to allocate towards private equity? And you have 10 seconds to answer this question. Interesting. Okay, 5, 4, 3, 2, 1. Polls are closing. And let me share the results right here. So over 50% of you answered that they would invest 10 to 25%. Approximately 38% said that they would invest slightly less than 10%, and 12% are the very high risk appetite participants who would like to invest 25 to 50%. Very interesting. The average for high net worth individuals, their average capital allocation is on average 16%. So 10 to 25% is very much in that range and seems to be a sensible allocation towards private equity. So why should you invest in private equity? We take an impact view and a financial view to answering that question. From an impact point of view, our hypothesis is that you can have a lot more impact by investing in private markets than in public markets. And to properly understand that, we need to understand two concepts. Typically, when we think about impact, we conflate or we confuse the two concepts of company impact and investor impact. Company impact is the amount of impact that the company has itself. So for example, Tesla is a company that has a whole lot of impact, but that is not the same as investor impact. Investor impact is how much do I change the growth or the success of Tesla when I buy a share of equity in Tesla, right? So we should separate the concept of company impact and investor impact. And we should be asking ourselves as investors, how much impact, how much investor impact am I having? There are two key ways in which you can have investor impact. One is through shareholder engagement. So if you look at shareholder engagement in the public markets, an awesome initiative, in my point of view, is a company called Follow This, or it's a nonprofit. And what they do is they pool very large institutional shareholders and they're activist shareholders. So they create proposals for shareholder resolutions for companies like Shell, or try to vote in board members that have a climate agenda. So engagement is one way to influence a company. And typically engagement is very high in private markets. A venture capitalist is super closely involved with what a company is doing. In buyouts, you actually have majority control. So you have full control over the strategic direction of the company. So that's one way to have an impact. And second is capital allocation. How much of a difference does it make when you invest an X amount of capital in the company? You can imagine that in a large public company that is self-funded and that does not depend on external financing to fuel its growth, that the impact of buying shares or adding capital is limited or can be limited. But in a venture stage fund or in a growth stage company, external funding is everything. It's do or die, basically. So the impact of adding external capital to the success and the growth of a company in that phase is many-fold the impact that you have in public markets. So I'm not saying that public market investing has no impact or is not good. That's not the point. But you can have a lot more and more direct impact in private markets and in public markets. Another reason to invest in private markets is the opportunity space. Interestingly, these are a few facts from the United States. In the US, there are 7 million private companies versus only 4,300 public companies. And the number of public companies has dramatically decreased over the past 20 years. So the number of public companies actually decreased by almost 50% in the last couple of years. And why is that? Because companies are staying private much longer because there's much more capital in the private markets. And that means that public investors, retail investors in the public stock markets are missing out because the value creation opportunity is happening before a company goes to IPOs on the stock markets. Think of an Airbnb or any of these tech companies which have massive value creation, huge returns, then they go to the stock market. And that's where everybody exits. And that's where the early employees and the founders and the investors exit. And that's only when retail investors come on board. So being able to get into the game early is interesting. And of course, if you look at it from a returns point of view, private markets have outperformed the listed equities, though you add different indices will tell you different stories. But here are 10-year returns coming from KKR, in which the average internal rate of returns, average annual per annum return of private equity here in the middle of the slide was 13.9% per annum versus 9% here on the left side for listed equities. So 4.9% spread. That makes a huge difference in the long run. If you look at 20 million, and if you had invested 1 million 20 years ago at 9% per annum, you would have made a very decent $8.4 million. But if it had been at 13.8% return, then you would have made almost $24 million. So compound interest, that's really investing 101. But what is very critical is manager selection, with which we mean what fund should you be investing in? Because what this chart shows is that there's a lot of variability in the returns of funds. Here on the right side, you see the spread of venture capital and private equity. And what you see is that average returns here for private equity or for venture capital are on average around 15%, around 13% for private equity. But the spread is huge. So top performing funds actually perform 33% better, returning almost 46% return per year. That is just actually unfathomable. But there are also funds that have performed significantly worse than 15% per year. So what is super critical and something that a carbon equity or another fund of funds helps you do is really select the top managers, in which we always talk about what are the top quartile, the top 25% performing fund managers. And in the case of venture capital, those are funds that return between 22 to 45% per annum. Yeah, then the question, is what does make a great fund? And Wiebe, would love to hear your input there.
Yeah, exactly. So what is it we're looking for, right? So what are the criteria that we assess when selecting the right manager and fund? And this slide provides you an overview. It does focus on, let's say, all the non-impact matters, right? So impact aside, these are the things that we will focus on, and that's the things you want to focus on when you diligence a fund. So most importantly, it's the investment team. How experienced are they? What's the composition and what's their track record? Have they been making similar investments in the past, and how successful were they? Probably the most important factor is team. Second one is organization. Sometimes teams are part of larger organizations. So what is the governance of such a setup? Are we aligned with the investment team ultimately? And how institutionalized is such an organization? Again, can they replicate his past success through that way?
Wiebe, what do you mean by how the level of institutionalization?
It's that processes are set up such that each investment decision is making the same way, and you can compare and contrast, and you make the best decisions. But also, it's reporting standards.
Yeah.
Do they comply with all the guidelines, and are they transparent in reporting to LPs? That's all very important in assessing the quality of a manager.
Cool.
Then thirdly, the investment strategy. Do they have a well thought through sourcing strategy? Do they have a huge pipeline to choose from? Ultimately, if you want to select the best investment opportunities, you want to have multiple choice. And are they able to source great opportunities? That's important. How do they create value? You touched upon it earlier. We will go into that for every fund manager, every opportunity. What is it they have been doing? Can they replicate it also in the future? And sometimes there's a portfolio that we can look into. If a fund has started making a couple of investments, then you have some visibility on what the portfolio will look like. That's great. Sometimes you have none. Then that's not an option, but then you will look into the pipeline. Does it look attractive or not? And does it fit their mission and their strategy? And then finally, we'll look into the fund terms. The most important aspect on the fund terms is really getting the alignment right with the team. Making sure that they invest their own capital in a meaningful amount, and that there's a performance fee that rewards outperformance. That makes them tick. And then what is it we're doing in assessing it? So we'll do desktop due diligence on each fund, go through the data room, all their documents, and run analyses. We'll interview the team members, and we'll do reference checks with other investors, with former CEOs they work with, or former employers, to making sure that their past track record is tested and analyzed. And we'll benchmark the fund against other opportunities, and ultimately also see, does it fit the overall portfolio that we're constructing? So these are the things that we'll focus on for each and every opportunity, and ultimately that's the way you want to select the best managers.
Excellent, thank you. All right, before we go on to the next section on how to invest in private equity, Lara, have any questions come up from the audience?
Yeah, I have one interesting question that may be worth to address here, given the content we just discussed. It's a question by Martijn Mulders, and he's asking, due to the inflow of capital from the public markets actually moving to the private markets, like hedge funds entering private markets, if we see any increase in competition to invest in those funds that we have in our pipeline. So I thought maybe interesting to address, because indeed, this is something we're seeing. I think across the board, what we're seeing in our pipeline is funds are getting a lot bigger. We have several multi-billion funds in our pipeline currently focused on climate that are set up by large general GPs, very experienced GPs. However, what we also see is they all tend to flock kind of to the same funds, where they all get together. They're mostly well-known funds, with many funds under management, so with long track records. So they're not looking at every fund across the board. So not all of them are getting that competitive. Further, we also see climate-focused funds like to have a diversified set of investors. So even though there may be many financials interested to invest, they're also looking to have more impact-engaged capital, like carbon equity or others, who really understand the impact metrics, how to become a really impact-oriented fund investor, and therefore are still open to add investors like us to their investor base.
Thank you. One thing to add, I think, yes, you see a lot of competition increasing for private market deals, and very interesting to see hedge funds sort of going lower in the chain, and sort of everybody's sort of you've increasingly big funds, and then everybody's moving a step forward as growth equity fund investment funds that are trying to invest a little bit earlier, perhaps into a late Series A, etc., so that they try to get into the deal earlier. So there's definitely a lot of competition. There is a lot of valuation pressure. You see that in the public and in the private markets. I hear quite a lot of funds saying like the expectations are pretty insane. Something for us to really have a look at, when we evaluate funds, what valuations are they paying? Are they paying too much? Do we understand the valuation that is being paid? And what is the competitive edge of a fund to win deals without paying the highest price? So yeah, great question. Thank you. So let's move on to how to invest in private equity. There are three ways, or there are more ways of investing in private equity, but three main ways that I would like to cover here. You can either invest directly into companies, either as an angel investor or a direct investor if you have a sizable amount of capital, or if you have a small amount of capital, you can invest in crowd equity funding, One Planet Crowd, for example. You can invest in funds, or you can invest in fund of funds. I won't cover direct investing here too much. Typically what you should know about direct investing is, I speak to a lot of investors. So people have different motivations. And I see typically that people want to be involved as an angel or as a direct investor when they like what the company does, or when they have a lot of knowledge or network in that space. So you have a lot of value add. I also see a lot of angel investors who have done quite some angel investments and then realize that it's super time consuming and also much more risky, or it takes a lot more time than they originally thought, right? So angel investing or direct investing is really something to do when you have people in your personal network, you want to be super actively engaged with the company and you have something to add. For most people who want to have exposure to private markets, but want to diversify a little bit, to take a little bit less risk, or quite a lot less risk, actually, that's when it makes sense to invest in a fund. And the key characteristics of a fund is that you have exposure to a portfolio, typically of 10 to 20 companies. You have funds that do a lot more investments. You have funds that do fewer investments. But on average, you get ample diversification. And a second characteristic of investing in a fund is typically that it's a blind pool fund, meaning that you wire the money to a fund and you don't yet know what a company or what the fund will be investing in. Maybe they've already built a bit of a pipeline. And maybe they've already warehoused, they've already done a few investments that will be part of the fund. But you also need to trust the manager that they will make the right investment decisions. So again, something where you look at, for example, the track record of a previous fund or the expertise of fund managers to do the right deals. And of course, we make that assessment for you too. Here, quite interesting to see sort of like the risk profile, the probability of a return multiple compared between direct investing and fund investing. So at the top, you see the probability of a certain return multiple when you invest directly into a company. Two things to observe. First of all, there's a 30% probability of a zero return, meaning you lost your money. So it's very high risk. Again, 30% approximately of startups fail. But on the other end of the spectrum, there is also a 12% probability of making a 10x return. So it's what I said, it's do or die. Either you lose or at times you win very big. So again, it's a very high stakes, high risk bet. In a fund, you have diversification. So the risk of making a negative return is rather or very low. But also the probability of making a 10x return is lower than it would be in the case of a direct investment. So again, to make a relatively safe and interesting above public market returns, a fund investment is typically a safer option than a direct investment. And then you can actually diversify further, which is what we call a fund of funds, which is where you invest in a portfolio of funds. And that's where you spread your investment across, say, anywhere between 5 to 20 funds. And the risk of capital loss then almost goes to zero. And typically these fund of funds will give you exposure with a single ticket. What in carbon equity, the fund of funds will, from a 100K ticket, offer you exposure to between 50 to 100 different climate tech companies. So a lot of diversification. And these funds may be partially a blind pool. So in the case of the carbon equity fund of funds, we will already give you a view on the portfolio and announce a couple of initial funds that will be part of the selection. But also you will have to trust us that we make the right investment decisions for you and that we make the right fund investments. So partially blind pool. Here you see what that means. And this is the probability of a portfolio returning less than the capital paid in. So here is the risk of capital loss if you invest in a certain number of funds. Again, the risk of losing money in a VC investment is rather small, especially if you invest in top funds. But here, if you say the risk decreases the more fund exposure you have. So with a single fund, that's 23.6%. But if you were to invest in 9 funds, the risk of capital loss is less than 1%. So basically non-existing. All right. So more diversification typically is better. The way that I see it is, for investors who have, in excess of say 500K net worth and who are comfortable doing direct investments in a single fund, you can build your own multi-feeder portfolio of say 100K tickets through a platform like Carbon Equity. But if you have less capital, say you want to invest in total 100K or in the future 50K, then it's better to invest in the fund of funds because you get more diversification for the same amount of capital. All right. So Lar, have any questions come up on this part, or shall we continue?
Actually, many questions are coming up, so I'm rushing to try and answer them as much as I can. But not any that I can pick out right now. So let's continue and address them when we.
Cool. All right. I have one more poll to ask you, and this is about impact preference. So I'm very curious. Are you return driven or sustainability driven? And remember, this is an anonymous survey, so feel free to be perfectly honest. And so on the one extreme, you can be return driven, where return is the single focus. On the other extreme, I see people who say, I only want impacts if I can make any return at all. That's, you know, a cherry on the cake. But where are you on that spectrum? I'm gonna give you a few more seconds to vote. All right. Okay, I'm going to count down 5, 4, 3, 2, 1. With 61% of the votes in, here are the results. I see the majority, 40%, is returns minded. I look at impact, but return is the most important variable. And then that's followed by 28% of people who say balanced impact and returns are important. And interestingly, also 24% of people who consider themselves sustainability minded, where return is important, but impact is even more important. Thank you very much for your honest answers. And I think that very much reflects the discussions that I have had with many investors. Cool. All right. So how do funds work? And Wiebe, may I hand it over to you?
Yeah, sure. So let me start first with explaining a couple of terminology. We've been using fund manager and investors before when looking at this structure chart of a fund investment. I want to introduce the concept of general partner and limited partner. I'll be using these terms going forward as well. The fund manager is generally referred to as the general partner. And all the investors in a fund, either through a fund of fund or directly, are the limited partners with limited liability. Now, these funds are closed-end funds. So what does it mean? It means that there's only a short period of time where the fund is open to new investors. Typically, this ranges from 3 to 12 months. And at the end of that period, the fund closes and no new investors are allowed in. And then the lifetime of the fund to actually invest and sell companies is approximately 10 years. Some larger, especially in the climate space, but 10 years is pretty standard. So let's run through an example of a commitment to such a fund. So how does it work? Let's assume you invest 100 in the fund. You have to pay some fees and costs over a period of time, mostly in the first 5 years, and then slowly going down thereafter. But the first 5 years is what's called the investment period. The fund manager will make new platform investments and build a nicely diversified portfolio over the first 5 years. And typically in venture, it will be somewhere between 15 and 25 companies. Growth funds might have slightly less diversification. There's also a little bit less risk on the business model side. So depending on the strategy, the portfolio is either larger or not. Following the first 5 years of platform investments, there's some capital also available for follow-on investments. That's especially important in venture capital, whereby you want to support the winners further. So in years 4 to years 8, you want to support them with more capital and make them grow even faster and in new rounds. So let's say from Series A, you follow the company in Series B and even Series C sometimes. That's why you allocate part of the capital for those companies. And then in year 6 to year 10, you hope that the fund will do well. And in this example, it does actually very well. They will start selling these businesses. And that's called the harvesting phase or the divestment phase of a fund. Now, if you look at the cumulative cash flows, you see the so-called J curve. So this is the cash flow for investors in a fund. And you will see that the first 5 years, it's really only cash outflows mostly. But from let's say year 6 to year 7, you will reach break-even point. You will get as much capital back as you invested. And anything thereafter is really your capital gain or the profit to you. So it's fairly back-ended. That's a good thing to really keep in mind. These are funds that have a longer lifetime and it's not liquid. So you invest for the future, but the return profile is such that it's worthwhile. So what do you pay for such an investment? The two most important things are management fees and carried interest. So typically you pay approximately 1.5 to 2.5% per annum of your commitment as a fee to the manager. And the larger the fund, the lower the percentage typically. But besides the management fees, there's also a performance fee. It's called carried interest. And once the fund reaches a certain minimum return hurdle, typically around 8%, the GP gets, let's say, a share of all the capital gains, so-called carried interest. And that's approximately 20% typically. So those two factors are the costs associated with investing in a private markets fund. Let's talk about the return metrics. It's good to get an understanding of what gross and net money multiples are, because those are typically the metrics that people use in communicating the success of a fund. So let's start on the left. If it's the same example, you commit 100 to a fund. How is it broken down? Approximately 15 will ultimately be allocated to fees and costs, and 85 will be invested in actual companies within the fund. In this example, I've assumed that the fund will make a 2.5 times gross money multiple on those investments. And then ultimately the total proceeds will be 212.5. So that's 100. It's kind of the paid in capital and 112.5 capital gain. Now that doesn't all flow back to investors. 20% of that capital gain, the 112.5, will ultimately be paid as a performance fee. That's the carried interest. And then ultimately 190 will flow back to investors. So in this example, as a fund investor, you would make a 1.9 times net money multiple. So after all the fees and carry you paid. So the gross money multiple at the portfolio company level is 2.5 times. The net money multiple is 1.9 times. And that is actually the real return you make on all the capital you've invested. So it's good to understand the terminology and to compare those multiples. every fund manager will report both of them. So it's just to improve your understanding of these metrics.
Cool. All right. I think we're running quite short on time, so I would like to actually park it here and go into the questions, the Q&A. Lar, I can perhaps share the presentation for now, so that we can fully go into the Q&A. Lar, would you like to kick off with a question from the Q&A? And also, I would like to invite you to raise your hand in the chat if you would like to ask a question in person.
Yes, of course. So I have saved a few questions that I think are interesting to address. And I think the first one is actually one for you, Wiebe, that I've actually decided that this was not mentioned by this person. So it's a question by Suzanne Rosman. And she says, the answer must be, it depends, but how would you suggest potential investors look at first-time startup fund managers? Is the team and pipeline there most critical?
It's an interesting question, especially for climate tech. There are a lot of new first-time funds out there, and if you look at the dispersion of outcomes of potential returns of funds, I have to say quite a few of the underperforming funds are linked to first-time teams. So you need to be careful when assessing those, but doesn't mean they can't be interesting opportunities. I would pay a lot of attention to the team itself. Focus on their previous track records. What have they been doing in the past? Is it relevant or not? That's ultimately very important, right? In the team. Now, it does certainly help if you already have some visibility on what the fund will look like. We're looking currently at a fund that is already raising, let's say, over 6 months, and they have made the first 5 investments in the fund. That provides a lot of comfort, and it shows what is it actually going to look like? What am I going to invest in? You don't always have that benefit, but with first-time funds, I would certainly wait until you have some visibility on what the fund will actually look like. And you can buy that time. Most of the time, fundraising will take up to 12 months. So buy yourself some time and spend time on team, past track records, do some reference checks, and wait until there are some portfolio companies. So yeah, you're right.
Yeah, maybe to add also is that what we also do is create portfolios of funds where in our fund of funds proposition, you actually create a set of funds where for some you can take additional risk on, for instance, first-time team, but balance that out with funds that have more experience and therefore diversify those types of risks as well.
Great.
All right, then one other question, and maybe Jacques, this is one you can also address. It's one by Sabine Schouten, who we all know well. What do you see as the biggest challenge for the unique proposition that carbon equity offers in entering the fund investment markets?
Yeah, I think the question asked there is, how do we make sure that we get into the top funds, right?
Indeed, or we could also, if you pull it more broadly, the fund investment market, the investment market itself is a heavily regulated market, so there are quite a few boundaries we have to take into account.
That is a great question. Actually, if you look at private market investing, there are 2 hurdles to regular private individual investors participating, unless you are a ultra high net worth individual. And the first is that typically you have to invest a ticket of in between, let's say, 1 to 10 million euros to even participate in a fund. And I'm not sure how your personal financial situation is, but most people don't have a few million lying around, because again, if you want to invest, say 10, 20, 30% of your portfolio, that means that if you want to invest, say a 2 million ticket, you would need an average net worth at least 6 million. So capital, the minimum amount of capital is a big hurdle, but the other one is regulatory, because regulation requires very strict requirements to retail investors participating in private market funds. So ultimately, carbon equity, for example, will need to obtain the full AIFMD license, Alternative Investment Finance Directive, about which Lara is an absolute expert by now. And to be able to offer below the 100K. So currently you will notice that the minimum amount to be invested in carbon equity is 100K. That's because of regulation, because we currently operate under an exemption of the AFMD regime, which then requires that you invest a minimum of 100K. But once we have the full license, we will be able to offer below 100K, and that's the objective of carbon equity, of getting those tickets smaller so that more people can participate and that we have more impact as a company.
Great. I think that just answers also Tim Rutgers' question about what the minimal investment amount is going to be in the long term. And also what kind of technology plays a role in getting there. And I think our ambition definitely is to go lower than that 100,000. We don't know exactly where we'll end up, but we want to go down to 50 to 10,000 and maybe even lower. And technology and automation will play a very important role in achieving that goal.
Yeah, Lara, a question coming in from Michiel Scholte. He says, maybe I missed it during the presentation, but what is the performance fee rate and the hurdle rate in your fund of funds? Actually, we haven't actually mentioned the carbon equity fund of funds. Maybe you want to say a few words about the upcoming decarbonization fund of funds and also performance fee or hurdle rates.
Yeah, absolutely. So a few words. We are this month launching our fund of funds, the Decarbonization Fund 1, which, as we mentioned a few times, will be a portfolio of funds. We'll select there 3 to 5, or if we raise a really good amount of capital, 7 underlying venture capital and private equity funds. We already have a range of interesting funds in diligence. Jacqueline mentioned a few as examples earlier in the webinar. Those are all funds in our pipeline that could potentially end up in that fund of fund portfolio. Our fees, well, to start with, hurdle rates and performance fees, no need to worry about those, as we do not have a performance fee in our fund of funds. It's a flat fee, management fee of 0.75% annually over your total commitment. So that's the fee. That's all the fee there is. So nothing difficult to calculate beyond that.
All right.
Okay. So let me see what else is coming in. We discussed something about funds in the pipeline.
Yeah, maybe that's an interesting one.
Yeah, and maybe also one that I see come up already several times, a little bit about what carbon equity brings to GPs as added value beyond kind of being impact oriented. What we've seen so far, we have developed in-house, led by our head of impact, Lisa Rubenstein, a climate scorecard, which we use for our diligence process, where we very granularly look at how a fund performs on the climate angle, both on how they select deals, how intentional it is, if they look at materiality, etc. Those factors and that scoring we actually share back with the GPs. And we then create a conversation after we make our investments to help them improve on their scoring on all of those factors. And we use it as a guidebook. Since there are really not any standards in the private market industry yet on how to be a good climate impact fund and how to invest for climate, they're actually really open and happy with our help in defining what those best practices should be in the end. So we have a very engaging conversation with the funds on that topic. And that's also their value add and our expertise we can bring to them.
Yeah, Lara, I have a great question coming in from Guilherme Shirazawa. Apologies if I did not pronounce that correctly. In your view, is the venture capital industry capable of meeting the funding needs from deep tech climate-related companies? So technologies like nuclear fusion, grid-scale storage solutions, construction material and production. It seems that the industry is too much focused on the low-hanging fruit and is afraid of technology risks associated with deep tech. Great question.
Great question. And, and also very true. If you look in the overall general VC industry, you see a lot of appetite for kind of the direct to consumer solutions, things you can buy in a supermarket that are easy to understand and easy to scale. However, thankfully, in our pipeline, we have several funds who are taking a different view and actually have most of the technologies you just mentioned in their pipeline or already in their portfolios. Typically, you see those funds have strong technical expertise in their fund investment teams. make a lot of effort to do the required research and understand the deep technologies and what makes those scale and what the challenges are to make those scale, as well as building networks with, for instance, strategic partners, corporates, who can become the first buyers of those technologies to help them scale. So yes, we think venture capital has a role to play and can play a role, but it does require a very specific setup that we would also look for when they take that strategy.
Yeah, exactly. Yeah, great. Then we have time for one more minute, one more question. So if you want to have your question answered, then get it in right now. But here's a more technical question. What is a common way that fund money is fiscally and tax-wise optimally structured at? Or Wiebe?
Well, that's difficult to give a short answer on anything that's tax related.
Okay.
But I can answer how we structure it. We structure it in fiscally transparent structures, which essentially means that you will be treated as if you were a direct investor into that fund, which avoids double taxation. So I guess that's how we structure it. But it really depends on your situation and if you're investing from a private account or from a formal entity.
Yeah, excellent. All right. And then I'll take one more anonymous question here. What has been the appetite so far for carbon equities products? Well, I mean, it's still in the open, but we had a great initial product launch. So we had the 2150 fund, which was a very awesome fund, which focuses on decarbonization of the built environment. They are the ones that invested in Carbon Cure, and recently they invested in a cool company called AeroSeal together with Bill Gates at Breakthrough Energy Ventures. And so very cool fund. And that was a fund of a small fund for us, 3.6 million, but it sold out in 2 weeks. So that's very positive. And we'll be launching the fund of funds in 2 weeks, 13 October, we will go live. So stay tuned for that. And also, we will launch a feeder fund, 1 or 2 in the coming months. So we will keep you posted. All of you, I think, are in our newsletter list. So feel free. I mean, we will keep you posted. And once we have more information, you can always have a call and we'll make all the information available for you. Cor, do you have one more question that you would like to answer on stage, or I will allow you to talk? Or is that accidental? No. Okay, cool. All right. Thank you so much for participating in the webinar today. Thank you so much for the active participation and the great questions. Really appreciate it. Reminder, please do feel free to reach out if any questions were unanswered. You may email me at Jacqueline@carbonequity.com, or you can find us through www.carbonequity.com. There will be more seminars. So soon we will be doing a webinar on climate impact investing, specifically really highlighting the impact angle. And we will do more advanced webinars on deep dive topics to really understand more complex private market investing concepts. So stay tuned for that. And thank you very much. And I do hope to see you at future events, and also hopefully as future customers of Carbon Equity. So stay posted. Thank you very much.